If you're a homeowner, chances are you've opened your latest insurance bill and had that sinking feeling, that sticker shock. Well, you are definitely not alone. Costs are absolutely skyrocketing, and in some places, just finding a company to cover you at all has become a real challenge. Okay, let's dive in and break down exactly what's behind this great insurance squeeze.
Right? This is the big question. It feels like it came out of nowhere, it feels personal, and boy, is it hitting the budget hard. But this isn't random. There's actually a pretty complex mix of things going on, and in this explainer, we're going to untangle them one by one.
And just so you know you're not crazy, here's the data. According to the National Bureau of Economic Research, the average property insurance premium has jumped more than 30% since just 2020. So no, you are not imagining it. This is a massive nationwide trend.
All right, so here's our game plan. We'll start with that sticker shock you're feeling. Then we'll get into the perfect storm of reasons why this is happening. We'll do a little case study on California versus Florida, see how they're trying to find a solution, and finally, we'll wrap up with what all of this means for you.
Okay, let's kick things off with that sticker shock. And you're going to see pretty quickly, this isn't just a you problem. It's affecting homeowners from coast to coast.
Now check this out. A U.S. Treasury report broke down the costs, and it's pretty eye-opening. While rates are up everywhere, homeowners in the highest risk areas for things like hurricanes and wildfires paid, on average, over $2,300. That is a whopping 82% more than people in the lowest risk zones. It's a perfect picture of how much where you live is starting to dictate what you pay. And that brings us to the core of it all, the why. You see, it's not just one thing. It's more like a perfect storm of 4 different forces all hitting at the same time, pushing your bill higher and higher.
So these are the 4 big drivers we're talking about. We've got more natural disasters, much higher costs to rebuild, the rising price of something called reinsurance, we'll get to that, and in some places, a huge spike in lawsuits. Let's dig into those first 2 right now.
It's really a painful 1-2 punch. So on one hand, we're just seeing more disasters. I mean, think about it. In 2023 alone, there were 28 separate billion-dollar weather events here in the U.S. Then, on the other hand, when a home does get damaged, it's just way more expensive to fix it. The cost to reconstruct a home has soared over 63% in the last decade. Why? Because labor is more expensive, materials are more expensive, the whole shebang. It just means insurers are paying out more money, and they're doing it more often.
Okay, now for that third factor, which might be a new one for you, reinsurance. The simplest way to think about it is it's insurance for insurance companies. Yeah, really. See, when a massive hurricane wipes out an entire town, your local insurance company could actually go bankrupt trying to pay all those claims. So they buy their own insurance policy from these giant global companies to protect themselves from those huge losses.
And why should you care about this? Well, because those giant global reinsurers are feeling the pain from disasters happening all over the world. A typhoon in Japan or floods in Germany drives up their costs, which means they turn around and charge your local insurer more. And this quote says it all. In early 2023, those global rates shot up by as much as 50%. Now, your insurance company isn't just going to eat that cost. They pass it right on down the line, to you. So to see how this perfect storm is really playing out, let's zoom in on the 2 epicenters of this crisis, California and Florida. Now, they're dealing with different main threats, but the pressures they're facing are popping up all over the country, from the Gulf Coast with its hurricanes to the Midwest with its tornadoes.
So in California, the #1 threat is wildfire. And the big problem is that major insurers like State Farm are just leaving. They've stopped writing new policies altogether in many areas because the risk is too high. Then you have Florida. Their main peril is hurricanes, but their crisis got supercharged by that 4th factor we mentioned, lawsuit abuse. This is where a massive wave of questionable or just plain fake claims, often pushed by contractors after a storm, just blew up costs for everybody.
This quote from consumer advocate Carmen Balber really captures the frustration people are feeling in California. As the big private insurance companies pull out of fire-prone areas, homeowners have nowhere to go except the state's insurer of last resort, which is basically a more expensive, government-backed plan that was never designed to cover this many people.
Meanwhile, in Florida, they argue that their problem wasn't just the storms, it was a broken legal system. And as this quote from the Florida Chamber suggests, they believe that by passing some major legal reforms, they've started to fix the problem and are even attracting new insurance companies back into the state.
Which brings us to the solutions. And Florida and California have taken 2 totally different roads. You could almost frame it as trying to solve the problem with lawsuits and legal reform on one side versus a more science-based regulatory approach on the other.
Florida's strategy was all about aggressive legal reform. They passed these big new laws in 2022 and 2023 that were designed to make it much harder to file bogus or inflated claims against insurance companies. And according to the Florida Chamber, it's actually working. They report that 11 new insurance companies have come into the state, and dozens of others are either lowering their rates or at least holding them steady for now.
California, on the other hand, is trying something different. They're essentially striking a deal with the insurance companies. The state will let them use these new high-tech wildfire models to set their prices. These models use AI and climate data to predict future risk, not just look at past fires. But here's the deal. In exchange, those companies have to agree to write more policies in high-risk areas, not fewer. It's a bargain designed to keep the market from totally collapsing.
So, after all that, what does this new reality of more expensive, harder to get insurance actually mean for you, the homeowner? Let's bring it all home, so to speak.
Well, the consequences are pretty serious. A growing number of people are just going without insurance entirely, over 14% of homeowners in 2024. In some places, those crazy high premiums are actually pulling down property values. And maybe the most dangerous thing is that people are cutting corners on their coverage. A staggering 60% of homeowners don't have flood insurance, probably because they think their regular policy covers it. Spoiler alert, it does not.
But you are not powerless here. There are real things you can do. You can harden your home against whatever your biggest risk is. That might mean fire-resistant siding or hurricane shutters. Even basic maintenance helps. You should always ask your insurer about discounts for making these kinds of upgrades. And most importantly, take a hard look at your policy and make sure it actually covers what it would cost to rebuild your home today, not what it was worth 10 years ago.
And all of this leaves us with one final, pretty unsettling question. You know, for generations, home insurance has been a basic part of owning a home, a cornerstone of financial security. But as the climate risks keep growing and the cost to rebuild keeps climbing, you have to ask, is home insurance on its way to becoming a luxury that only some of us can afford?